Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Jake Moilanen of Seraph Group. Jake, thank you for joining us.
Oh, thanks for having me in the hot seat.
Great. So what was your background before you started investing in early stage?
I started out as a complete geek. I was early in my career, I was doing computer programming, flipping bits at IBM, getting the mainframes to boot up from the very first time. And I kind of progressed to doing the same thing, but putting them together to make supercomputers. So I got to make these big, massive machines work for the first time. And the biggest one I got to work on was one called Mare Nostrum. At the time, it was the fastest one in Europe, the fifth fastest in the world. And eventually kind of moved on from doing that to went back to business school and UT and got my MBA and went out to Silicon Valley to kind of learn the ropes of the startup world and did a few startups of my own. And after I exited both of those, I switched over to being a full-time investor. And I spent about half my time doing early stage investment and half my time on the public markets doing quant trading.
So you invest in seed and Series A early stage companies. What led you to focus on those sectors?
One of the things, like I said, I did a lot in the public market, and you kind of look at what advantages you have as an investor. You typically have kind of three advantages. Either have an information advantage, just knowing more about the company and know more about what's going on. You have an analytical advantage, so you can see what's publicly available and just analyze it better. Or the third thing is you have a behavioral advantage, so you're able to kind of stomach the losses and hope for things to go up sometimes. And I think that the nice thing about early stage investing is you kind of get all three of those, which you can't necessarily do on the public market. You can't get an information advantage, at least legally. You can have computers help with the analytic stuff, but the alpha there is kind of going down. And it's really easy to have a massive drop, say Christmas Eve this year, and want to get out. So I think the nice thing is about early stage investing is you really can get a lot more alpha out of that than you can on the public markets today. Additionally, I should also add that other big advantage, you can also sway a company in your favor. So with my background and experience as an operator and my network, I always felt like I'd always sway a company's results kind of in a more favorable light, which does make a difference. You can't do that on the public market.
Right. So for those who are investing in the seed and Series A stage, what would be your advice for them? What have you learned that you would share with them at this point?
To really invest, you need an edge. I mean, if you don't have an edge, it's really difficult to make long-term returns. And I think if you're going to start out in the area, I think the thing you need to do is go in an area that you know better than someone else. So you want to reduce your information risk. So if you say you know more about data stores and for infrastructure, then go focus on areas that you know more about that than someone else and you know what actually is a good company. And then also diversify. I've done the math on this quite a few times, and you need at least 10 investments at a minimum to diversify your risk on early stage investments. Ideally, that's closer to 20. Because all the returns on early stage is very skewed. So it's really easy to lose a lot on a few investments and a handful that will kind of make up for that. So, and if you can't do 10 investments at least, then you probably should get into a fund that can kind of diversify for you.
So how do you see the industry evolving with funding early stage companies, especially in the seed and Series A? Where do you see it going?
Yeah, if you look at Silicon Valley and if you look at their assets under management, so just how much money they have under all the venture capital funds, it's up 54% in the past 5 years. Where you look at Austin, it's down 27%. And a lot of that's that you see like Austin Ventures kind of going the wayside. But the reason is you have all these multi-billion-dollar funds being launched. And this wouldn't be an issue if the number of startups being started was up 54% in Silicon Valley, but it's not. It's only up 5%. And so it's kind of just basic supply and demand. You see because of this, the valuations have to rise. There's just more money for the same number of startups. And when you have this increase in valuation, you see the VCs have to change their tactics a bit. They have to change how they do investments. They have to go more towards favoring what the power curve distribution. So companies that are going to be skewed even more to having very, very large exits. And that means they have to look for unicorns and all those billion-dollar companies. The challenge is that if you go from a seed round investment to a unicorn status, that only happens 1.28% of the time. And that's really hard to find those type of companies. And that this is saying is that venture capital, there's an art and science to it. The scientists know how to price the 95%, and the art is knowing the 5% where valuation doesn't matter. And if you look at Silicon Valley, they're somewhat pushing that 5% to 15%. And that's tough. The 95% accuracy in valuing is really how you get consistent long-term returns. And so one of the ways, what I'm really kind of see this going though, is that a lot of these multi-stage funds have a reason for these valuations to be marked up. They need to kind of show their LPs that the higher numbers, and so they have incentive to have higher valuations on some of these. And that means that some of these valuations get away from these companies. And with the overvaluation, I think it's going to start catching up to them. It starts to become an issue when you start going to the public markets. If you look at Lyft IPO'd at $24 billion, and around the time of this recording, it's about $16.5 billion. The public markets aren't agreeing with what Silicon Valley is saying. There's been a few successes like Zoom, but I think it's going to be a lot of these companies are going to get shorted down and pushed down to lower valuations. And if this keeps occurring, I think the Silicon Valley valuations are going to have to get right-sized, and this is going to cause a lot of these late-stage funds to lose a lot of money. And I think it's going to be a challenge. It's not going to be a bubble, but it's going to be a correction.
Well, that's good advice and good insight into the industry and where it's going. So for your fund and what you're doing, what is your investment thesis and what sectors do you focus on?
Yeah, so we focus on early stage hardware, software, biotech, and medical. And we kind of have two main components to our thesis. We look for geographies that don't have the same type of issue that Silicon Valley does. They have funding gaps, like Austin, Chicago, Atlanta, Washington, D.C., and Salt Lake, for instance. And we see that getting these better valuations leads to more consistent long-term returns. We've been around for 15 years, and one of the reasons why we've had such consistent returns is that we have gone for the accurate valuing of the 95%. So we're made up about 300 LPs from across 100 cities, and they really help us source a lot of these deals for us, which allows us to see a lot of these deals from these different geographies that have these funding gaps. The other major component to our thesis is that we believe that you can use computers to help the actual performance of an overall fund. If you kind of look at the public markets of the 1950s and 1960s, they were pretty efficient. But once kind of computers came into the mix, they got even more efficient. Now, if you look at the venture capital side, they're today about as efficient as those 50s and 60s were for public markets. And this has kind of caused by using computers, this kind of allows us to hopefully do a much better job of actual things like portfolio allocation.
So do you have any specific startups that you can point to that highlight the thesis and some examples of what you guys invest in?
Maybe we could take a step back and kind of talk about a little bit more about the thesis. I think that might highlight a little bit how we got to some of the startups we're looking at. When we started doing this thesis, it was kind of like a little bit of a journey. After I sold my second company, both my companies were very heavy machine learning algorithm based. And of course, as soon as I left and started just investing on my own, I felt compelled to write an algorithm to publicly trade on the stock market. And so I spent about half my time doing that and half my time doing early stage investing. And I started seeing just opportunities as far as how I can actually use an algorithm to help in things like portfolio allocation and managing risk. And one of the things that public quant algorithms really do is help manage risk and figure out what is an appropriate risk level. But you look at early stage investing, it's tough to see what those risk levels are. So I kind of started on this goal to kind of write an algorithm for help with my own personal portfolio allocation. If you spare me a little indulgence here, Paul, I'll tell you briefly about what this algorithm does. So what we do is I go and look at comps for a company. So for instance, say you're Austin-based doing SaaS that's in the revenue center side of the house. I would go pull comps for a company, just like you might pull comps on MLS for a property. I go to Crunchbase and PitchBook and pull comps for that company. And from those comps, I'd be able to look at a few hundred companies and I get a few things out of there. I get the amount of time to liquidity. So say you're doing a seed round investment, what's the average time to liquidity? Say it's 5 years. Then we also look at the amount of dilution that occurs after that. And say, for instance, it typically is about 50% from a seed round. So I know that if my target for me is a 35% IRR, I take that and compound it by the time to liquidity, which is 5 years. That really is about a 5x multiple. Now take that 5x multiple and now you get diluted down by 50%. That 5x multiple now becomes 10x. So if a company comes to me and says, I have an $8 million post-money valuation and I need a 10x multiple on that, that means they have to exit for $80 million. Now we can look at those comps and see how often has that ever actually happened. And it's going to be a small percentage. It's going to be like maybe 4 or 5% of the time. But from that, I can use something called Kelly criterion, which is actually very similar to if you guys ever play poker or ever do any type of gambling. It's actually the same math, and it really is to kind of use to figure out what is the optimal amount of bet size, or in our case, an investment size we should do to kind of maximize the chances of success given that risk level. And so I took this and to make sure that the math actually worked, I took this algorithm and I created 1,000 sample portfolios pulling from just make random companies and that we had public information on. And I used these different portfolios to have different mixes based off of three approaches. This algorithm approach, an equal weighting, which just means giving this a 20 company portfolio, just giving 5% to each company of funds assets. And the final approach was a very traditional one where it says at Series A, a fund wants, say, 20% of the round of the company. And that's how they base off how much they want, is just based off they want a certain percentage of the company. And I benchmarked all 1,000 sample portfolio companies or portfolios and see which ones actually performed using real companies. The only difference is the allocation percentages. And this algorithmic approach ended up winning about 80% of the time. The equal weighting won about 19% of the time. And then one of the more traditional approaches of taking a certain percentage of the company only won 1% of the time. And so this really kind of proved that, at least from a mathematical standpoint, that this approach does work. And so that's kind of how we started looking at almost all our investments. We said, okay, we have this algorithm approach which just says we should do one thing. Our gut says we should do something else. And when they aren't in alignment, we kind of say, okay, what's the algorithm missing or what is our gut missing? We kind of try to come to the truth of what the reality of what the real answer should be. And so we kind of started using this for the Austin Fund. And while we don't have any publicly announced companies on this yet, we did run this on every single company we could find since 2003 and let it help screen out what a perfect, the all-star portfolio might be. And without this algorithm knowing anything really, it didn't have any information about these companies and fully automated. It picked 20 companies. And the top four in there are kind of well known. It was Instagram, WhatsApp, LiveRail, and Mint. And it ended up being an IRR of 297%, which is not bad. But so it was one of those where we know that the computers can do a decent job of picking things. And so we wanted to really bring that into the fold on the Austin Fund. And we believe that it's going to do quite a bit better by having adding the computer element into the actual decision-making process.
Well, it seems like there's more data now available for startups than there was even 10 years ago. And so we can start to put more quantitative metrics behind it. A lot of equity investments in general have always been qualitative by nature and checking the gut and looking at the team and then hoping for the best after that. But it seems like there's enough startups now that you can apply more of a quantitative method to it as well. So it'd be interesting to see how the Austin Fund plays out compared to the other ones in the Seraph group.
Absolutely. We're excited to kind of see the results.
So you probably don't have any startups on that fund just yet, but let's talk about the challenges in the space as far as what do you see as the challenge in investing in seed and Series A companies? What would you say about that?
I think one of the challenges is, again, measuring risk levels. We can use our algorithm to help, but there's challenges even in that. If you look at just the data that is available, a lot of it is retrospective. And a lot of things we do from a venture capital side is that we're inherently looking forward. And so it makes the data difficult to use at times. Then you look at business models, they vary dramatically. So it's really tough to kind of model out a business model that changes over time. It's not like a CPG where it's a very defined business model that you can repeat and model out for every single company. A lot of these startups are all dramatically different. And also kind of like the idea of like garbage in, garbage out. If you have a bunch of garbage data coming in, which people have a tendency of maybe not being as truthful because there's no gap accounting then for startups, then you get garbage out, which is always a challenge when you're trying to do any type of early stage type of investing. So I think these challenges, regardless if you're using an algorithm or just doing it in general, it's really tough to get a sense on. That's why you see a lot of investors that have done very, very well have fallen back on just looking at things like the team. I think the thing that we're kind of hopeful for is you can still do both.
So where do you see the risks in this space? Is it technical? Is it the market? Is it regulatory? Where do you think the challenges or the risks will come in the actual execution of these deals?
Yeah, I think one of the challenges we're seeing is I think that the long-term prospects of companies, there's a real possibility because so many companies are staying private, not going public. Getting to a liquidation event can sometimes draws out the time to liquidity quite dramatically. If you look at some of the paths, if you don't have a clear exit defined at maybe a Series B or a Series C type time frame, there's a real chance that a company might become a zombie company. So a company that does just well enough to stay alive, but not well enough to ever exit. And that really destroys your IRR because you have money tied up for a decade sometimes, or even longer. And so I think one of the challenges is trying to identify those companies that can have a very long-term great prospects and tackle a very big problem with also the possibility that they might become a zombie, and how to make sure you have things like redemption rights to get out of those bad situations.
Great. So you're in several sectors there. Which of these sectors do you think are going to be the best immediate opportunities to pursue?
One of the things that I look at, I really try getting a sense of where certain markets are going to develop. And I think one of the challenges you really run into a lot of times also is timing. Trying to time markets well is very, very hard. But you can actually do a decent job or better job than I think a lot of people realize. I mean, there's a few different models out there. One of them people are very familiar with is called Moore's Law, which is just, if you look at it from the cost perspective, is just the cost to produce something goes down as a unit of time. So say every 2 years, the cost gets cut in half. But there's actually another one out there called Wright's Law, which is conceptually similar. But instead of looking at time, it looks at how much cumulative doubling of production has there been. So for instance, how many widgets have you produced? And whenever there's a doubling of widgets produced, how much of a decrease in cost has there been? Now, if you use this, it's been proven by Santa Fe Institute did this study that concluded that Wright's Law is far more accurate as a general technology predictor of cost than say, Moore's Law. And the reason is that if you look at Moore's Law, that really doesn't take into account demand. So, for instance, if the demand for memory went off a cliff, then you wouldn't have the same type of investment in R&D that's going to get the reduction in cost, where Wright's Law really takes into account demand quite well. And so I've been using this to help forecast out what different sectors are going to do better. And one of them that I think I'm super interested in, but I yet to actually find a company that I've been wanting to pull the trigger on, is actually robotics. If you look at kind of robotics, they've been really over-engineered for the past number of years. And that was a lot because the software to write for them was very, very hard. But things like deep learning have made it much, much easier to actually write software for things like motion control, as well as the rise of 3D printing. This really sped up the design iteration process needed to do a better job of these robots. I think with the number of robots being increased and produced now, that's going to, with Wright's Law, is going to show that there's going to be a decrease in costs, which then means there's going to be an increase in demand, which then feeds back into the loop, and there means more cost decline. And this is, I think, going to really, really cause for a commoditization of robots. And while I don't want to be in a robot company per se, I want to be in a company that can take advantage of this massive cost decline and this new market that's opening up. And so I'm looking for companies right now that really can take advantage of what will be a commoditization of robots, I believe, in the next 5-10 years.
Well, it's great. It'd be interesting to see how that plays out. Robotics are coming. It's just a matter of how fast and how soon, and be interesting to see how this thesis plays out in that. In the last few minutes that we have here, what else should we cover that we haven't?
I think we covered a lot of ground. I'll spare listeners any more out of my rants here, but the only thing I'd mention is that we are in the process of raising our Austin-based fund. We are almost fully closed for first close, but if anyone's interested, definitely come reach out to me. We're doing about 50% of our assets go to Austin, 50% go to other geographies that also have these similar funding gaps.
Great. Appreciate your taking time. And how best for the listeners to get back in touch with you?
LinkedIn, Twitter, any of the above works.
Okay. We'll put that in the show notes, and appreciate your taking time and hope to have you back for a follow-up soon.
Oh, thanks. All was fun.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.